Hello everyone, the Fed shocked Wall Street this week. While a lot of people were hoping for them to pivot and U-turn with the rate hikes, they just did the opposite. But following the data, the Fed has no reason whatsoever to pivot. But this is getting a lot of people scared. So in today's video, we are going to go over how the market reacted to those news and why the Fed continuing to raise rates it makes sense, what the Fed report is saying about the future rate hikes, and the changes in the policy path, and finally, what this might mean for the whole economy that is getting the investors scared right now. So everyone, let's not waste time and let's get straight to the news, facts, and the data. Okay, look at this everyone. So this Friday, the US Central Bank approved another sharp rise in the interest rates as it wrestles to rein in the fast rising prices. The Federal Reserve said it was raising its key interest rate by 0.75 percentage points, taking the bank's benchmark lending rate to a target range of 3.75 to 4%, thus lifting to its highest rate since January 2008. Now let's see how the market reacted to this news and why. At the beginning of the conference, even though the rate hike was announced to be the third consecutive highest, the market reacted positively to this news. One might wonder why. Well, market tried to gauge whether the Fed thinks it can implement a less restrictive policy that would include a slower pace of rate hikes to achieve its inflation goals. But then, Powell pushed back against expectations for a premature pause in rate hikes. Treasury yields initially fell following the release of the statement, but then rebounded. Stock markets slid, with the S&P 500 index closing down 2.5% for the day. The Federal Reserve continuing to raise rates, it kinda makes sense. But why? Well, simply, looking at the data, you can clearly see that the effects of previous rate hikes haven't yet properly kicked in. There is a lag in time, and the inflation hit 8.2% in the US last month. That is down from June when it rose to 9.1%, the highest rate since 1981. Even though a decline in energy prices has helped ease the pressure, but the cost of groceries, medical bills, and many other items is still rising. That is adding hundreds of dollars to the monthly expenses of typical households, as wages, while increasing, have not kept the pace. Mr. Powell said clearly restoring price stability was key to maintaining a healthy economy, and said that he saw few signs as yet that the pressures were easing consistently. While it remains unclear how high the rates will ultimately need to go, Mr. Powell said they look likely to end up higher than the banking policymakers had previously expected. The US actions come as many other countries also raise rates in response to their own inflation problems, which have been fueled by a mixture of factors, including higher energy prices as the result of the war in Ukraine. The sharp rise in borrowing costs has already started to cool some parts of the economy, such as housing, but there is still to go. The bank hopes pushing up borrowing costs will cool the economy and bring down price inflation, but critics are worried the moves could trigger a serious downturn. The question now is what the Fed report is saying about the future rate hikes and the changes in the policy path. On balance, Powell dismissed the idea that the Fed might be pausing soon, though he said he expects a discussion at the next meeting or two about slowing the pace of tightening. If you look at this graph, this cycle's rate hike is the one with the highest pace since 1987. The central bank's new statement hinted also at potential change in how it will approach monetary policy to bring down inflation. The new statement hinted at that policy change, saying when determining future hikes, the Fed will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. Economists are hoping, and it seems that this is the much talked about step down in policy that could see a rate increase of 0.5 point at the December meeting and then a few smaller hikes in 2023. Now, what all this means for the economy, and why is it getting the investors scared right now? Well, the chairman also expressed some pessimism about the future. He noted that he now expects the terminal rate, or the point when the Fed stops raising rates, to be higher than it was at the September meeting. With the higher rates also come the prospect that the Fed will not be able to achieve the soft landing that Powell has spoken of in the past. However, he said that the need for still higher rates makes the job more difficult. Concerns are rising that the Fed, in its efforts to bring down the cost of living, also will pull the economy into a recession. Powell has said he still sees a path to a soft landing in which there is not a severe contraction, but the US economy this year has shown virtually no growth, even as the full impact from the rate hikes has yet to kick in. At the same time, the Fed's preferred inflation measure showed the cost of living rose 6.2% in September from a year ago. The GDP declined in both the first and second quarters, meeting a common definition of recession, though it rebounded to 2.6% in the third quarter, largely because of an unusual rise in exports. On Wall Street, markets have been rallying in anticipation that the Fed soon might start to ease back as worries grow over the long-term impact of higher rates. There is little, if any, expectation that the rate hikes will halt anytime soon, so the anticipation is just for a slower pace. Current market pricing also indicates that the Fed funds rate will top out near 5% before the rate hike ceases. Although it's really hard to foresee the outcome of this, for sure, one can only speculate, but the probability of a recession hitting in 2023 is greater than it was before. We shall hope for the best. Anyway, we would be interested to hear what you think, so feel free to place your comments on the video. And also, if you like our page and would like to stay informed and up to date in similar topics, please hit the like button and subscribe. Thank you guys for watching, and we hope it was helpful, and see you on the next one.